Value at risk is a statistical method to quantify the level of financial risk, that is the maximum potential loss associated with any financial asset over a specified time frame, say overnight, 1 month, 1 year, etc. Financial institutions use value at risk to measure potential losses in their loan portfolio or in their investment portfolio comprising bonds, equity, stocks, foreign exchange positions due to changes in exogenous variables. That means variables outside their control such as interest rate, exchange rate, market prices, etc. Value at risk is built around the fundamental concept in statistics of the bell curve: normal distribution, median, mean, and standard deviation. Those of you not familiar with the concept of normal distribution and standard deviation, please see the web link at the end of this video. There are 3 methods to compute value at risk. The Monte Carlo simulation, which is based on hypothetical historical data, the parametric model, which does not require data at all, and the historical simulation, also referred to as the parametric model, which is based entirely on historic data. Of the 3, the most commonly used value at risk model is historic simulation, which is the basis for our discussion here. To understand how value at risk is computed and used in measuring risk, let's look at a couple of examples. Let us say an investor had yesterday purchased equity shares of XYZ company at 510 CCU per share. Our objective is to use historic simulation to determine the maximum potential gain or loss should he sell it tomorrow. Using historical simulation, it would be possible for us to determine the average price, that means the mean mu, as well as the standard deviation sigma for that equity stock based on the data for the last 1 year obtained from the stock exchange where XYZ company's equity stock is listed and traded. Let us say the average price mu and the standard deviation sigma so arrived at for company XYZ is 500 CCU stock price and 100 CCU standard deviation, or 20% of the stock price of 500. Assume 250 trading days in a year. Now, recall your statistics lessons where standard error is equal to sigma by root n, and therefore daily volatility would be 20% divided by root 250, which is equal to 1.265%. Again, recall your statistics lessons. At 95.5% confidence level, the maximum expected price on the following day would be mu plus 2 sigma. That means mean plus twice the standard deviation, which would be 500 into 1 plus 2 into 1.265%, which is CCU 512.65. And the minimum expected price on the following day would be mu minus 2 sigma, which is 500 into 1 minus 2 into 1.265%, which is CCU 487.35. And at 99.9% confidence level, instead of the 95% confidence level that we used earlier, the maximum price would be mu plus 3 sigma, which is 500 into 1 plus 3 into 1.265%, or 518.97 currency units. And the minimum price would be mu minus 3 sigma, which is 500 into 1 minus 3 into 1.265%, or 481.03 currency units. In other words, based on statistical data on price movements for the equity stock of XYZ company in the last 1 year, the maximum loss that the company is likely to incur overnight due to adverse movement in price would be the purchase price of 510 minus the worst case likely price tomorrow of 487.35 currency units at 95% confidence level, which would mean a loss of 22.65 currency units. And the maximum loss at 99% confidence level would be 510 minus 481.03, which would be 28.97 currency units. In other words, one could say that the value at risk for that stock is 22.65 at 95% confidence level and 28.97 currency units at 99% confidence level. Let's look at another example of computing value at risk and how it is put to use. Data for the past 1 year shows us that short-term rates has on an average, that is mean U, been 5% per annum with a standard deviation sigma of 0.5%. Given the objective to estimate the likely short-term lending rate for the coming fortnight, the computation would be as follows. Again, recall your statistics lessons where standard error is equal to sigma by root n. So volatility for the fortnight, which is 0.5% divided by root of 26 or 0.098%. With the above statistics, we can estimate that the call money rate during the coming fortnight at 99% confidence level would be a maximum of 5% plus 3 into 0.098, which is 5.294% per annum, and the minimum would be 5% minus 3 into 0.098 or 4.706% per annum. Now let's see how this data can be put to use. Let's say the interbank dealer in a bank receives an offer whereby he could borrow 100 million currency units at 5.5%. Based on the above computations, he should not accept the offer because the computed short-term rate is likely to be lower than the quoted rate, i.e. 5.294% at 99% confidence level vis-a-vis 5.50% that he is being offered. On the other hand, if the interbank dealer has already contracted to borrow $100 million at 5.5% per annum, then the maximum potential loss to the bank would be 564.38 currency units per day on the borrowed amount of 100 million CCU, arrived at as the difference between the contracted rate of 5.5% per annum and the computed lowest possible rate of 5.294% at 99% confidence level. Hope those two examples helped clarify the concept of value at risk. May I reiterate that the value at risk model is based on the core statistical principle of bell curves, normal distribution, mean and standard deviation, and is used extensively by financial institutions to value their portfolio of assets, loans, investments, etc., to determine the maximum likely loss in the event that prices, interest rates and exchange rates vary by up to 3 times the standard deviation sigma for each of the assets on its balance sheet. For those of you who wish to have a more rigorous understanding of value at risk, please review the web link provided at the end of this video. And finally, one of the shortcomings in the value at risk model is the assumption of the bell curve or normality in the movements of prices, interest rates and exchange rates over a given time horizon. During times of extreme volatility, as we witnessed in the 2008 global financial crisis, the value at risk model felt terribly short of estimating potential losses as the market prices moved way beyond the minus 3 sigma assumption underlying the value at risk model. And therefore, ever since the 2008 global financial crisis, the value at risk model as a measure of estimating maximum potential loss has been subject to enormous scrutiny and criticism.